Click the bell icon to get latest videos from Ekeeda.
Hello friends, let us do one question asked at university examination where we are not required to prepare vertical balance sheet but we are required to calculate balance sheet ratios with given information. In such case, without preparing vertical balance sheet, how to do the ratios, that we'll understand from this question. Let us read question. Following is the summary balance sheet of Star Products Limited. Equity share capital. This will be part of shareholders fund, share capital. General reserve, part of shareholders fund. It's a reserves and surplus. Securities premium, reserves and surplus. 10% debentures, borrowed funds is secured loan. Profit and loss account, reserves and surplus. Sundry creditors, current liability. Bank overdraft, current liability. Provision for taxation, current liability. Proposed equity dividend, current liability. Let us go through the assets. Fixed assets. Investments, these are long-term investments. Stock, current asset. Debtors, current asset. Prepaid expenses, current asset. Advance income tax, current asset. Cash bank balances, current asset. Share issue expenses, these are fictitious assets. This will be deducted from shareholders fund. Preliminary expenses deducted from shareholders fund. This is also fictitious asset. You are required to compute the following ratios and give your comments on each ratio with reference to standard ratio. Current ratio, liquid ratio, proprietary ratio, stock working capital ratio. Preparing balance sheet in vertical form, clearly it is given, is not required. First we have current ratio. Formula of current ratio is current asset upon current liabilities from balance sheet. Now we'll take details of current assets and current liabilities. We have marked here current assets, stock, debtors, prepaid expenses, advance income tax, cash bank balance. We have marked current liabilities, sundry creditors, bank overdraft, provision for taxation, proposed equity dividend. total current assets 15 lakh 30,000 divided by total current liabilities 9 lakh 55,000, we get current ratio 1.60 is to 1. Next ratio we have liquid ratio. Formula for liquid ratio is liquid asset upon liquid liabilities. Liquid assets we can calculate with the help of current assets. Current asset minus inventory or stock minus prepaid expenses divided by liquid liabilities. We can calculate current liabilities minus overdraft minus income received in advance. Out of current assets over here, prepaid expenses is not a liquid asset. Advance income tax, this is an amount paid to government towards current year's tax liability. So this is not a liquid asset. Out of current liabilities, bank overdraft is not a liquid liability or quick liability, as it is an arrangement with the banker for a long period where business must have given some security like stock and debtors or any other fixed asset. While calculating current ratio, we have calculated total current assets 15 lakh 30,000 minus stock 8 lakh 50,000 minus prepaid expenses 40,000 minus advance income tax 78,000 divided by total current liabilities 9 lakh 55,000 minus bank overdraft 3 lakh 95,000 total liquid assets 5 lakh 62,000, total liquid liabilities 5 lakh 60,000. So liquid ratio is 1.003 is to 1, that is almost 1 is to 1. Next we have proprietary ratio. Formula for proprietary ratio is proprietor's fund divided by total asset, that is fixed asset plus investment plus current assets multiplied by 100. For calculation of proprietor's fund, we will require to consider share capital, equity share capital 5 lakhs, add reserves and surplus, general reserve 3 lakhs, securities premium 25,000, profit and loss account 7 lakh 40,000 minus fictitious assets, share issue expenses 10,000, preliminary expenses 30,000. equity share capital 5 lakhs, general reserve 3 lakhs, securities premium 25,000, profit and loss account 7 lakh 40,000, minus share issue expenses 10,000, minus preliminary expenses 30,000, divided by fixed assets 13 lakhs, long term investments 4 lakhs. We already calculated current assets 15 lakh 30,000 multiplied by 100. Total proprietors fund 15 lakh 25,000 divided by total assets 32 lakh 30,000 multiplied by 100, we get proprietary ratio 47.21%. Next we have stock working capital ratio. Formula for stock working capital ratio is closing stock divided by working capital multiplied by 100. We can also consider closing stock divided by working capital means current asset minus current liabilities multiplied by 100. We had calculated current assets and current liabilities while calculating current ratio. Total current assets 15 lakh 30,000, total current liabilities 9 lakh 55,000. The amount of closing stock we have 8 lakh 50,000. Closing stock 8 lakh 50,000, current asset 15 lakh 30,000 minus current liabilities 9 lakh 55,000 multiplied by 100. Working capital is 5 lakh 75,000. So we got stock working capital ratio 147.83%. We have calculated all the ratios. Now let us go for commenting part of the question. First, current ratio 1.6:1. Standard current ratio is 2:1. So this company is not having satisfactory current ratio. Company has to either increase current asset or decrease current liabilities or do both to have standard current ratio. Standard current ratio is 2:1. Therefore, current ratio of company is not satisfactory. Company should increase current asset and decrease current liabilities to achieve standard current ratio. This will help company to gain sound short-term solvency position. Liquid ratio of company is 1.003:1. That is almost 1:1. Standard liquid ratio is also 1:1. That means company is having satisfactory liquid ratio. Standard liquid ratio is 1:1. Therefore, company have standard liquid ratio indicating good short-term liquidity position. Proprietary ratio 47.21%. Standard proprietary ratio is around 65%. Therefore, company's proprietary ratio is not satisfactory. Company has to increase proprietors fund and decrease borrowed fund to arrive at Standard proprietary ratio. Standard proprietary ratio is 65%. This company have 47.21%, which is not satisfactory. Company's long-term solvency position is poor. Company should increase proprietors fund and reduce borrowed fund. Stock working capital ratio 147.83%. Standard stock working capital ratio is 100% or less than 100%. Here company's stock working capital ratio is more than 100%, which is not satisfactory. Company has to reduce its stock and improve inventory management so that excess funds will not get blocked in stock. Standard stock working capital ratio is less than 100%. This company have 147.83%, which is not perfect. It shows poor stock management. Company should improve inventory control by reducing unnecessary stock to bring this ratio at par with standard. In this question, we have calculated necessary ratios and also given our comments. When we are not required to prepare whole balance sheet, we are required to read all balance sheet items carefully and calculate all the ratios. Thanks for watching this video. Stay in tune with Ekeeda and subscribe to our channel Ekeeda. Thank you.